Finding investment strategies that, well, actually deliver consistently, especially when markets feel uncertain. It really can feel like you're searching for a needle in a haystack.
It absolutely can, which is why today we're doing this deep dive. We're really zeroing in on one specific equity income approach, one with a track record that's, frankly, quite compelling.
Right. We're looking at the Guinness Global Equity Income Fund. We've got their latest quarterly report, some background info, and, crucially, details on how you, the listener, might access this strategy.
Exactly. And that access point often comes via DVM, that's deVere Asset Managers, part of the wider deVere group. We'll touch on that.
But the thing that really jumped out at us, and probably you too, is this claim. The underlying portfolio strategy has consistently ranked in the top 3 global dividend strategies over 10-year periods.
That's a pretty bold statement, and it definitely deserves a proper look. Is it backed up?
That's the mission for today. Let's unpack the thinking behind it, how they actually pick stocks, and look at the performance data.
Okay, sounds good. Where should we start? Maybe who's running the show?
Good idea. So the fund itself, the Guinness Global Equity Income Fund, is managed by Dr. Ian Mortimer and Matthew Page. They're Guinness Global investors.
And this isn't a new fund. It launched back at the end of 2010, currently managing, let me check the figures. 5.1 billion downs in this specific fund.
And the overall strategy?
The strategy itself has even more behind it, about 5.9 billion in assets as of March 2025, so quite significant.
And the firm, Guinness Global Investors.
They've been around since 2003. Interestingly, they're 100% employee-owned.
Oh, that is interesting. Often aligns interests quite well.
It can, yes. They manage about 8.3 billion in total. And for this fund, they measure themselves against the MSCI World Index. It's their benchmark, their comparator.
So boil it down for us. What's the fund trying to do for an investor?
Fundamentally, it invests in global companies, equities, that offer a dividend yield higher than that benchmark, the MSCI World. But importantly, it's not just a high-yield hunt.
Right, there's more to it. Their philosophy seems key. They talk about quality, value, and dividend growth. Let's start with quality. What does that mean to them?
Quality for them means businesses with consistently high returns on capital, persistent returns, and strong balance sheets. They have this really quite strict screen.
The 10-year one.
Exactly. They look for companies that have generated a return on capital over 10% for 10 consecutive years.
10 years straight. Why such a long time frame? Why 10%?
Well, the 10-year period is designed to smooth out economic cycles. Most cycles are shorter than that, you see. So if a company maintains that level of return for a decade, it suggests, real resilience, not just a cyclical high.
Makes sense. It filters out the flashes in the pan.
Precisely. It points towards a more durable business model. They also tend to prefer larger companies over $1 billion market cap for diversification and maturity, and companies that don't need tons of debt to grow and that actually prioritize returning cash to shareholders.
So it's a really high bar for quality. Okay, what about value? How do they approach that?
It's a bottom-up approach. So they focus on analyzing individual companies first, and they're looking for value in a few ways. Is the company cheap compared to the market, compared to its peers, compared to its own history?
And ESG is in there too.
Yes, ESG factors are integrated into that value assessment. It's not just a separate box-ticking exercise.
Got it. And the third pillar, dividend growth. So not just chasing the highest yield today.
No, that's crucial. The current yield is decent, 2.1% net versus the MSCI World's 1.7% gross. But the main goal is finding companies that can and likely will grow their dividends year after year. It's about a growing income stream over time.
A sustainable growing income.
Yeah.
Okay. And I heard it's a concentrated portfolio, not hundreds of stocks.
That's right. Typically around 35 holdings, and they start them off equally weighted. This shows real conviction in each pick.
35 stocks.
Well,
so each one really counts.
It does. And they hold for the long term, thinking 3-5 years, which means low portfolio turnover. They're not chopping and changing constantly.
All right, so that's the philosophy. How does that translate into the actual process of picking those 35 stocks? What are the steps?
They describe it as systematic, repeatable, robust. It starts with a universe of about 600 companies globally. These are the ones that pass that initial high return on capital screen we talked about.
Wow, 600 from the entire global market. That's already a significant filter.
It really is. From those 600, they prioritize further based on quality, value, and dividend growth potential. Then, if they're considering adding a new stock...
What's the trigger?
They want it trading below their estimate of its intrinsic value. They need confidence in a sustainable dividend. And importantly, it has to offer a better risk-return profile than something already in the portfolio.
Then the deep dive analysis begins.
Exactly. Proprietary financial modeling, really understanding the business, the risks, the dividend prospects, the valuation. There's a qualitative assessment too, competitive advantages, market view. And ESG scoring comes in here as well, based on the SSB framework, focusing on financially material factors.
SASB, so it's quite specific to the industry.
Yes, which many argue is more meaningful. They look at the company versus peers and its own history on those material ESG points. It feeds into their overall view of the business quality. For you, the investor, that suggests a potentially more integrated approach to responsible investing.
And companies that look promising but aren't quite right yet.
They might go onto a watch list, maybe wait for a better price or for space to open up in the portfolio. If a company fails the analysis, it's simply rejected.
Very disciplined. Okay, so they've picked the stock. How do they build the actual 35 stock portfolio?
As mentioned, they start with equal weighting. This helps manage risk. No single stock dominates excessively. They ensure diversification across sectors and geographies with specific limits, like on direct emerging market exposure. And that long-term view means low turnover. Macro factors. They consider them, but mainly at the company level.
And selling. When do they decide to get out of a stock? Must have clear rules for that, too.
Absolutely. A sale might be triggered if their assessment of the company's quality drops, if the valuation gets too stretched, if the dividend outlook sours, or if their basic reason for owning it, their conviction changes.
Any examples?
Yeah, the report mentioned selling Henkel recently in Q2 2024. Reasons cited were slower growth, margin pressures, and a dividend that wasn't growing. That fits their discipline.
Okay, philosophy process.
Yeah.
Now, the big one. Risk and performance. We have to state the obvious first, right? Investing involves risk.
Always. Equity values can fall, income can fall. And critically, past performance doesn't guarantee future returns. We always have to say that.
Definitely. But that past performance is what underpins that top 3 claim.
Yeah.
So how has it actually stacked up against its peers?
Well, according to their Q2 2025 report, data up to end of March 25, over 10 years, it ranked 3rd out of 31 funds in its peer group.
3rd out of 31. That's impressive consistency.
It is. And since launch, back in late 2010, it's also ranked 3rd out of the 13 funds that have been around that long.
So top tier over the long run. What about shorter periods?
More variable, as you'd expect. Over 1 year, it was 18th out of 53. 3 years, 12th out of 50. 5 years, 11th out of 46. It's that long-term consistency that really aligns with the claim. For you, thinking long-term, that resilience could be quite attractive.
And the income aspect. Dividend growth is key to their philosophy.
Yes. The report shows the growth in cumulative income over time, illustrating how that dividend stream has built up since launch. They also specifically analyze how the fund behaves in market sell-offs.
Interesting. How does it handle downturns?
Generally, it's held up better than the wider market. Lower downside capture is the technical term. Their data suggests, on average, during major corrections, it's captured only about 75% of the market's fall.
So it goes down less when things get rough.
That's the idea. The focus on quality, profitable, dividend-paying companies seems to provide some resilience. For instance, during the inflation and Ukraine war worries in 2022, the MSCI World dropped over 10%, but the Guinness Fund fell by about 7%. That relative protection can be really valuable.
That cushioning effect is definitely appealing. Okay, what about the overall total return picture since it started?
Since inception to end of March 2025, the total return that's capital growth plus dividends was 343.5%.
How does that compare?
Pretty close to the MSCI World Index, which was 347.2% over the same period. But significantly ahead of the average fund in its sector, the IA Global Equity Income sector, which returned 213.7%.
So competitive with the global market, but well ahead of its direct peer group average.
Exactly. And on a risk-adjusted basis, looking at return versus volatility, it has generally ranked in the top quartile, the top 25% of its peers over those longer periods.
Okay, solid performance picture, especially long-term. Let's peek inside the portfolio. What kind of companies are we talking about? Any familiar names?
Definitely some familiar names. You've got Analog Devices, Coca-Cola, Danone, Diageo, Nestle, PepsiCo, Procter & Gamble, lots of consumer staples. Also names like Microsoft, Johnson & Johnson, Roche, ABB, Texas Instruments, TSMC.
A mix across different sectors. Any recent changes mentioned?
Yes. They highlighted buying Publicis, the advertising group, in Q2 2024, citing its digital strength and growth potential. And as we mentioned, they sold Henkel around the same time due to concerns about its growth and margins.
So you see the philosophy in action there. How does the overall portfolio look in terms of sectors and geography compared to, say, the MSCI world?
The report breaks that down. They aim for balance, not huge bets on one sector. Geographically, it's global, mainly developed markets, but with some controlled emerging market exposure. They also show the portfolio's ESG rating distribution versus the benchmark.
And any key stats that summarize the portfolio's characteristics for the detail-oriented listeners?
Sure. Things like median return on capital, significantly higher than the market average, as you'd expect from their process. Median net debt levels are comparable. They provide PE ratios, free cash flow yield, dividend yield, payout ratios. One key stat is active share. It's high, around 90%, meaning the portfolio looks very different from the index. They're making active choices, not just hugging the benchmark. And finally, average yearly turnover is low, reflecting that long-term holding philosophy.
Okay, this sounds like a strategy with a clear philosophy, a disciplined process, and a strong long-term track record, particularly that top 3 ranking consistency. For listeners who are interested, perhaps intrigued by this approach, how can they actually invest? You mentioned DVM earlier.
That's right. For many investors, access to this Guinness strategy is available via DVM, deVere Asset Managers, which, as we said, is part of the deVere group.
And the fund structure itself.
It's a Dublin-based OEIC operating under UCITS rules. That's a European standard for investor protection. It prices daily. For UK investors, it has reporting fund status, which is relevant for tax, and there are different share classes.
Different currencies, income or accumulation.
Yes, exactly. Options for sterling, dollar, euro, and choosing whether you want the dividends paid out or reinvested automatically.
Where can people find all the official documents, the prospectus, the KIDs?
The best place is the Guinness Global Investors website. It's www.guinnessgi.com/literature. All the key documents are there, including details on the charges, the OCF, for each share class. That's the primary source. And again, DVM is a key route for access for many.
Right. So let's wrap this up. We've taken a pretty thorough look at the Guinness Global Equity Income Fund. We've seen its focus on quality, value, and crucially, dividend growth. We've explored the disciplined process, the low turnover, the concentrated portfolio.
And the performance, particularly that consistent ranking among the top global dividend strategies over the last decade. That really does stand out.
It does. It seems to back up that initial claim we discussed, which leads us to a final thought for you, our listener.
Considering everything we've discussed, the rigorous selection, the emphasis on consistent dividend growth, the long-term performance, and the potential access through platforms like DVAM within the deVere group.
How might a strategy like this fit into your overall investment plan? Does that focus on steady, growing income align with your financial goals, especially in a world that often seems obsessed with chasing the next hot trend?
It's definitely something to think about. How could this potentially complement what you already have? Worth exploring further, doing your own research. Remember, you can find more details online for both Guinness and deVere.
Absolutely. This deep dive really highlights how understanding the why and how behind a fund alongside its long-term results is so important when looking for strategies that might stand the test of time.